So Neil, 2014 is on pace as a record year in divestitures. What are you seeing in the capital markets?
Well, the last 12 to 24 months, the stock market as a whole has behaved very positively. And that's had a knock-on impact in relation to new money coming into the equity markets. And then if you drill into divestitures specifically, what we're seeing is more and more companies are getting ready or being prepared for selling businesses off. One is a straight sale of a business into the marketplace, or spin-offs in relation to standing up a new public company in an IPO-like format.
So if a company's planning to go down that separate company path, a spin, what do they need to do to get ready? What should they be thinking about?
In most situations in a spin-off, you're literally extracting an entity that's usually tangled up in a greater entity and standing it up on its own. One of the most important things, and something that needs to take place at the very beginning, is understanding the perimeter of the financial statements or the basis of presentation. What I mean by that is understanding what is being carved out. Is it a legal entity? Is it a collection of businesses? And then understanding what's been historically allocated in the ledgers and how has the business been run by management.
So Ravi, when we think about carve-out financial statements, one of the things we have to think about is the income statement and how we carve out the expenses. Can you talk a little bit about that process?
Sure. So when you think about the income statement, you are trying to reflect all the costs of doing business in that carve-out entity's financial statement. So there might be costs, let's say, that the parent picks up on behalf of the carve-out, or the parent company might have performed administrative services for the carve-out. Those costs need to be reflected in the carve-out entity's financial statements.
So when we talk about the income statement, though, let's think about some of the areas that can be a little challenging. For instance, taxes. How should companies be thinking about taxes?
So a lot of companies will take what's called a separate return approach to income taxes for a carve-out. So they're calculating income taxes as if that carve-out business filed its own standalone tax return. And that can be a little bit challenging because sometimes you might end up with differences between how the carve-out accounts for income taxes versus how the parent company would account for income taxes.
So what about other areas of the income statement that maybe are tricky or require some analysis, like stock comp or pensions?
So stock compensation, a lot of times you'll have employees of the carve-out entity that participate in the stock compensation plan of the parent. And again, those charges need to be reflected in the carve-out entity's financial statements. And then Beth, you asked about pensions. To the extent that you have employees that are participating in a parent company pension plan, a lot of companies will take what's called a multi-employer approach to accounting for that pension plan. So as opposed to carving out all the pension assets and liabilities and including those in the historical financial statements of the carve-out, they'll instead allocate a charge similar to a multi-employer type approach.
So let's switch and talk a little bit about the balance sheet. The balance sheet's a slightly different model. We're not really thinking about carving out the expenses or allocating the expenses. We're really thinking about attributing the assets. So can we talk a little bit about how a company thinks through that process?
Sure. So to the extent that you have assets and liabilities that are directly related to the carve-out entity, those assets and liabilities should be reflected on the balance sheet. So you think about things like trade accounts receivable or accounts payable. If they relate directly to the carve-out business, they need to be on the balance sheet. Where it can get a little bit trickier is when you have shared assets. So if you have, let's say, a corporate airplane that's owned legally by the parent, you're going to allocate an appropriate charge for use of that aircraft, but you're not actually going to put the aircraft on the books of the carve-out business.
So Ravi, any final thoughts for companies as they prepare carve-out financial statements?
Sure. It always takes a bit longer than you think in terms of putting together those carve-out financial statements. And so building enough time to put those together so that you don't end up with a last-minute fire drill.
So Neil, for a company to be successful in the carve-outs, what advice would you have for them?
A couple of things. One is ensure that there's executive sponsorship. These transactions have a habit of touching all parts of an organization. So having executive sponsorship is critical. Planning is critical in relation to having a proper project management or a project separation office that's set up. And then understanding the intersection between finance and deal structure. And then ultimately standing up a company on its own.
Well, thank you both.
Thank you.
Thank you.